As we stand by for that Bank of Canada rate announcement, let's get more from Warren Lovely, Chief Rate Strategist at National Bank Financial. Warren, thank you very much indeed for joining us. Bank of Canada expected to stand pat today. In October, it indicated we think we're done cutting for now. You said there was skepticism, but strong job numbers since then have changed a lot of people's minds.
Yeah, I think the earlier view has been validated, Andrew, to be frank, that we've had really some exceptional job creation. The job picture in particular has really surprised everyone, I think, including the Bank of Canada, to the upside. The growth picture's firmed, and inflation is still a little bit sticky here. So while there might have been skepticism that the Bank of Canada was done back in October, I think there's very little debate here that they're holding here at today's decision, staying home for the holidays, effectively.
It's funny, we have this job market in America that's been characterized as no firing but no hiring. And is it a little similar here in the sense that there's muted hiring in this country, or muted hiring expectations?
Well, that's the key word, expectations, Andrew. The actual data we're seeing from Statistics Canada show us exceptional levels of hiring.
Okay.
That does stand in contrast to expectations and sentiment indicators that suggest the labor market, the demand for labor is still quite weak. But what we have in hand are 3 straight job reports that really just did blow away expectations to the high side.
How reliable is that, though? Because aren't jobs figures notoriously volatile, and you get part-timers and stuff like that?
Yeah, absolutely. One month you never really want to put much stock in. 2 months you're maybe a little bit leery. 3, but you've got a better trend.
Warren, I'm very sorry to cut you off, but the Bank of Canada is holding its key rate at 2.25%, in line with what analysts had expected. Now, Tiff Macklem, the governor of the bank, saying he and his colleagues expect a weak print for the fourth quarter of GDP and moderate growth in 2026. Macklem, however, says comfortable with the near term for the economy. The latest data, and I presume he's referring to the strong job numbers that Warren was talking about, haven't changed our 2026 GDP and inflation forecasts, Macklem says, and naturally, and obviously repeating a theme that he has stressed, the upcoming trade deal review, the USMCA trade deal review, creates uncertainty for business. Bank of Canada still sees core inflation around 2.5%. Now, we know that the federal government does plan heavy infrastructure spending and spending on things like defense. Macklem, though, says impact from government spending plans will slowly filter through the economy. And Macklem also saying that tariffs have done damage to growth, but the economy is resilient overall. Warren, I know you haven't had a chance to go over what the Bank of Canada is saying, but it seems like they're sticking to their forecast economically and inflation-wise.
Yeah, well, if I just based on what you just read off there, Andrew, and my quick read here, it seems like they're trying to strike a bit of a balance here. On the one hand, the economy has been resilient. It's that job creation that we mentioned. The GDP data, upward revisions there have been a little bit surprisingly strong as well. What they're trying to say at the same time is, on the other hand, there's still a lot of uncertainty, particularly on trade. And let's just be a little bit cautious and patient as it relates to all those government stimulus dollars, all those investment dollars. Those will create investment and jobs, but they're likely to come a little bit later. I think this is the right assessment, to be frank. It's a balanced assessment. You don't want to be encouraging markets to be expecting interest rate hikes in the short term. I think that's far too premature to be providing that type of guidance. The other thing I think that they're saying as well is that, look, we're still watching inflation here. And underlying inflation, to be frank, in the last couple of months hasn't exactly gone the way they would want. So I think they're also still just being a little bit cautious as it relates to the inflation outlook here. Again, can't really declare victory fully when you still have inflation at the upper end of your target band.
We have seen the Canadian dollar slipping in trading after the announcement. Of course, who knows? I mean, lots of things drive a currency in the short term. It is interesting, though, that he doesn't sound too, as you say, he doesn't sound too confident about the economy, Tiff Macklem.
Well, I think, it's appropriate to be cautious here because, again, you just ask the average Canadian on the street, are you feeling confident? Do you have a lot of certainty as it relates to your own economic and financial situation? And I would think that most Canadians would say, not as much certainty as I would like. Mm-hmm. We still know that we have a trade deal. We're a small, open economy. This trade deal with the United States is going to be absolutely vital. That, more than anything, is the most significant risk factor for us to be thinking about as we move into 2026. Sure, those job reports that I mentioned have been very, very strong, but companies aren't exactly telling us there's a lot of urgency to add new hires, mm-hmm. additional hiring from here. So I think there's a lot of reasons to be a little bit cautious. The bank has done that. But at the same time, you do need to acknowledge the information that we have seen. And resiliency is a theme that we used to attach to the U.S. economy. Oh, the U.S. is so wonderfully resilient. It turns out Canada's economy, this trade-dependent economy, so focused on the U.S., has proven more resilient than most would have anticipated. And to some extent, that's a bit of a victory.
That's a good point. I mean, you'd think this would be really an economic, not disaster, but really damaging economically, a U.S. president launching an unprecedented trade war like that. I suppose, though, we have had this pronounced weakness, though, in business investment.
Absolutely. So you'll recall at the start of the year when it was a very dark chapter for Canada-U.S. relations all through January and February, March, we were modeling what these tariffs would do to the Canadian economy. And the Bank of Canada did this work as well. And the results were not pretty. It was a lot of destruction in jobs, a lot of destruction in output, adverse scenarios. The worst case scenarios were like recession or stagflation, which is probably the worst thing of all. And it turns out we've managed through this period of uncertainty with economic growth, with more jobs than we thought we would have. But this business investment piece, Andrew, that you touch on is key. Businesses have held back. They're still on the sidelines. And the Bank of Canada has made it clear in the past, we have a productivity crisis, problem, dilemma in this country. Fixing it will require businesses to be investing in machinery and equipment, and that's going to take a lot of time. And there's still, I think, a lot of uncertainty around that. The timing, the enthusiasm, the absolute level of investment that businesses are going to be comfortable committing to. And we haven't really flown the all clear flag on that front just yet.
Warren, thank you very much indeed for joining us. Really appreciate it.
My pleasure. Thank you, Andrew.
Warren Lovely, Chief Rate Strategist at National Bank Financial.